The S&P 500 has now seen 5 consecutive months of positive returns, yet despite this, we still have quite a few dividend stocks trading very close to their 52-week low. Now, just because a stock is at its 52-week low doesn't mean it's undervalued, but it can be a good place to start looking for opportunities. So in this video, we'll be looking at 5 dividend stocks that are currently close to their 52-week low, and a few of these I believe are actually trading at a pretty good value. To analyze these stocks, we'll be using my automated spreadsheets, which you can download on tickerdata.com, and also get access to the Ticker Data add-on that allows you to automatically import stock financials straight into your spreadsheet. Now, let's go ahead and dive into it. The first dividend stock we're going to look at that is close to their 52-week low is a quality compounder, and that is United Health Group, stock ticker UNH, trading at $455.25 per share, and we can see their 52-week low sitting at $445 per share, so it's getting very close to that 52-week low. Now, over the past year, they're down around 7.88%, and year-to-date, down around 12.58%, and we can see they recently took a little bit of a tumble after some recent news came out about this company with the Medicare Advantage payment update. If we scroll down, we can see a lot of health insurance stocks slid lower in after-hours trading just a few days ago, following reports that the Medicare Advantage plans will only be getting a 3.7% payment increase in 2025. So this wasn't news exclusive to UNH, this affected quite a few health insurance stocks. Now, we can still see over the past decade, this company has really outperformed the market up around 476%. And in fact, if we jump over to my stock screener spreadsheet, come up here and plug in UNH and hit enter, and you can see thanks to the Ticker Data add-on in Google Sheets, all this data will automatically load in. Now, immediately we can tell there's a lot to like about this company, especially when you look at these historical metrics. Look at the earnings per share over the past decade. 2013 going from $5.59 per share to 2023, $24.12. Revenue per share has exploded the same way during that time period, and then free cash flow per share has exploded over this time period as well. And we have to keep in mind, dividends are paid out of free cash flow. So for a company to increase their dividend payouts, their free cash flow has to increase as well. We can see shares outstanding has been declining, debt to assets in a healthy ratio, and their return on invested capital appears to be in a healthy range as well. So immediately, just by looking at this stock screener, we can see there is a lot to like about this company. Let's go ahead and move forward and look at the dividend metrics. So go ahead and come up here and plug in UNH on this dividend breakdown tab. And again, all this data will automatically load in. We can see this company has a low starting dividend yield sitting at just 1.65%, but look at the dividend growth rates for this company over the past 10 years. 10-year dividend CAGR of 18.26% and 5-year of 12.68%. They went from $1.05 in 2013 all the way to $7.29 in 2023, and with their most recent dividend hike, they're now at $7.52. So this company is rapidly increasing the amount they pay out in dividends, and it's also backed by massive free cash flow share growth during that time as well. We can see 16% free cash flow CAGR over the past 10 years and a 5-year free cash flow CAGR of 13.47%. So when we look at the free cash flow versus dividends paid out chart, the free cash flow growth has been slowing and it's not really choppy as well. We're seeing consistent free cash flow growth from this company, and the free cash flow is easily covering the dividend that is growing as well. So we can see a free cash flow payout ratio of just 26.33% in 2023. And if we look at the free cash flow payout ratio over time, we can see it stayed in a very healthy range over the past decade, staying between, it looks like, around 18% and getting as high as around 28%. So again, that is a very healthy free cash flow payout ratio over time, which is very impressive when you consider how fast they increase their dividend payments. Now, if we jump over to my valuation spreadsheet, you can see down here, UNH has a beta of just 0.55, so you should see low levels of volatility with this company. If we jump over to Graham's valuation and go ahead and zoom in, we're valuing the company based on how much their earnings are projected to grow, and we're also looking at current market conditions. We can see Ticker Data EPS is giving us an estimated average of around 26.5. Seeking Alpha gave us a little bit of a higher estimate, so I'm going to go with the middle of 27.5. I'm going with a growth rate projection of around 12, and after dividing by Y, which is the current yield on AAA corporate bonds, we come to an intrinsic value of $468.23. Now, if we look at our discounted cash flow analysis, we can see, assuming a free cash flow growth rate of 8% to the future free cash flows of the company, after finding the present value of those future free cash flows and adding them together, adding the company's cash and cash equivalents and subtracting out their total debt, we get their equity value, divide by shares outstanding, and come to a DCF price per share of $616.13. Now, I would like to perform a multiples valuation on this company, but it just doesn't make sense in this scenario because the company is so much larger than the other competitors in their industry. So the last valuation we'll look at is going to be our dividend discount model. We look at how much the company is currently paying out in dividends and how much that dividend is projected to increase in the future to find the fair value. And so with a dividend growth rate projection of 7%, 1%, discount rate of 8.5%, we come to a dividend discount model price per share of $536.43. So when we jump over to our output tab and average these three valuations together, we come to an intrinsic value of $540.26, which is a decent bit above the current trading price. With a 10% margin of safety, you could see the acceptable buy price sitting at $486.24, and with a 20% margin of safety, acceptable buy price of $432.21. So in my opinion, it looks like this company is trading at a pretty good value. And historically speaking, this company has been a compounding machine. When you look at their free cash flow per share growth over the past decade, it's no surprise this company has beaten the market so much and has also been able to rapidly grow their dividend payments during this time period. The second dividend stock right at their 52-week low is Nike, stock ticker NKE, trading at $89.07 per share. Now, this stock is truly right at its 52-week low. We can see its 52-week low sitting at $88.66. Over the past year, they're down around 26.79%, and year to date, down almost 18%. So they have been in a big downward spiral over the past year and year to date. Now, what's the reason behind this? Well, one of the big arguments is they are seeing some headwinds because of increased operating costs impacting the bottom line of their profit and reduced guidance from impacted sales. So let's go ahead and jump over to my profitability spreadsheet. If we come over here, plug in NKE, let's see if we can find out exactly what they're talking about. Okay, so the first thing that I noticed when we look at this chart here, we can see earnings per share slightly declined in 2023. Now, it wasn't a big jump. In 2022, they had earnings per share of $3.83, and in 2023, $3.27. But here's part of the problem. If we look at the revenue versus cost of revenue, in 2023, their revenue actually jumped up quite a bit from 2022, but the cost of revenue increased even more. So if we look at the gross profit ratio, we can see it's a little bit lower than it was in 2022. Gross profit ratio in 2023 of 43.52%, and in 2022, it was sitting at about 46%. So because of that lower gross profit ratio, less and less capital is finding its way to the bottom line. So we can see the 10-year average gross profit ratio sitting at about 44.67%, and in 2023, it was a little bit lower. Now, it's not a huge difference, but it does make a difference when you're looking at the company's bottom line. Now, let's go ahead and jump over to the dividend breakdown tab. Again, we'll come up here, plug in NKE, and hit enter. And again, all this data will load in thanks to ticker data. Now, we can see Nike has a starting dividend yield sitting at 1.66%. So again, we're looking at a lower yielding dividend stock, but they've seen very solid dividend growth. Now, if we look at the yearly dividend payout increases, one of the things you'll notice is at first glance, it looks like they decreased their dividends, but usually that's not the case for quality companies like Nike. This is more than likely a stock split. So if we jump back over to seekingalpha.com, click on dividends and click on dividend history and scroll down, look at the 10-year chart. We can see right here, that's exactly what happened. Nike had a 2-for-1 stock split. So in reality, their dividend payments have been increasing every single year over the past 10 years. So in fact, we can see their 5-year dividend CAGR sitting at 10.34%. So yes, they have been rapidly increasing their dividend payments. And we now know the 10-year dividend CAGR isn't a true reflection since they had a stock split. So we can go ahead and remove that. Now, free cash flow honestly hasn't been growing quite at a rate that I'd like to see it at for a company like Nike. We have a 5-year free cash flow CAGR of 4.4 and a 10-year of 7.38. Now, it is very clear that the free cash flow is easily covering those dividend payments, with the exception of 2020 when Nike generated very little free cash flow. But for the most part, they have very healthy payout ratios. We can see the free cash flow payout ratio trailing 12 months sitting at 41.3%. So it does look like the dividend is very healthy and it's growing at a healthy rate as well. Let's go ahead and jump into our valuation. Now we can see the beta for this company a little bit higher at 1.1, so you will see a little more volatility than that of the market. Now if we jump over to Graham's valuation, we'll go ahead and zoom in, and again, you can see we're going with estimated earnings per share of 3.7, a decent growth rate projection in line with analysts of about 13.5, and then we divide all of that by Y, which is the current yield on AAA corporate bonds. Now I do want to say that current market conditions driving up the current yield on AAA corporate bonds does drive down this valuation quite a bit. Under better market conditions, say the AAA corporate bonds was sitting at 3.5, we can see the intrinsic value jumps up quite a bit in that scenario, but due to market conditions, again, we're pushing down this valuation and we come to an intrinsic value of about $68 per share. Now, looking at our discounted cash flow analysis, we get a different story. Assuming a free cash flow growth rate of about 12.5% for the future free cash flows of the company, after applying cash and cash equivalents and total debt, we come to a discounted cash flow price per share of $99.47. That's a decent bit above the current trading price of $89. Now, typically, again, I'd like to look at the multiples valuation, but you can see the PE multiples of these comparable companies are really just all over the place. And I looked at Adidas as well, and theirs is very irrational at the moment as well. So this really isn't the best valuation in this scenario. So moving forward, we're just going to look at the dividend discount model here. And again, assuming a dividend growth rate of 7% and discount rate of 8.5%, we come to a dividend discount model price per share of $105.57. So when we look at our output tab and average all three valuations together, we come to an intrinsic value of $91 per share. It's a little bit above the current trading price, but not a whole lot. So with a 10% margin of safety, you could see our acceptable buy price sitting at about $81.90, and with a 20% margin of safety, $72.80. So overall, it looks like the company may be slightly undervalued, but personally, I'd like to see it go a little bit lower before I even considered buying. The third dividend stock we're going to look at is one with a much higher yield than the previous two we've looked at, and that is 3M Company, stock ticker MMM, currently trading at $90.54. Now this one's starting to get closer to their 52-week low, which is around $85.35, and we can see over the past year, down around 13.42%, and year to date, down around 17.18%. Now, what's the huge concern with this company? Well, this is something I was writing on Seeking Alpha about just the other day, and they are facing massive lawsuits. Lawsuits that are going to potentially force them to pay out over $10.3 billion. So these are a big deal. Now, that being said, it is possible that this could create opportunity if the company can handle these lawsuits. So let's go ahead and jump forward. We'll go ahead and plug in 3M into our screener and hit enter. And what I like about this screener is there's a few things we can tell right away. Okay, first off, we can see revenue per share. This is not a metric that is growing very fast. In 2013, it was sitting at about 45.27, and 2023 around 59. So yes, they have seen some growth, but it hasn't necessarily been very fast. Now, to be fair, this is a much more mature company. I mean, this is a dividend king we're talking about. They've been increasing dividend payments for over 50 consecutive years. We can see 2023, pretty rough year for the business with negatives earnings per share, which was the first time they had done that in quite some time. Now, if we go ahead and jump over to the profitability sheet, there's a couple of things I want to point out here. Now, yes, we can see the income metrics don't look good, but that's obviously because earnings per share was negative in 2023. But where my big concern is, again, this is a mature company we're talking about. We don't want to see declining gross profit ratios when looking at mature companies, but unfortunately that is the case for 3M. We can see the gross profit ratio decreasing over time with a 10-year gross profit ratio of around 47.56%, but the gross profit ratio in 2023 sitting at 43.46%. That's not a good sign for the company. Now let's go ahead and look at them from a dividend perspective. Now typically people love this company from a dividend perspective because first off, look at that starting dividend yield. It is massive, sitting at about 6.67%. And again, this is a dividend king, over 50 consecutive years of dividend growth. So when we look at the yearly dividend payout history for this company, it looks like dividend payments grew at a pretty solid rate. But when we look at the 10-year dividend CAGR, it's sitting at about 5.85%. Okay, that is pretty solid, but here's the problem. This dividend growth has slowed down considerably over the past 5 years with a dividend CAGR of just 0.95%. Now, something we have to keep in mind, anytime we see a company with a dividend growth rate below the rate of inflation, that company is technically paying out less in dividends every single year. So yes, the dividend payments have been growing slightly over the past 5 years, but in reality, inflation has eaten away at those dividend payments. Now, the reason those dividend payments have slowed down, in my opinion, are due to two causes. First off, we can see free cash flow growth for this company is now very slow. We have a 10-year free cash flow CAGR of just 2% and a 5-year of 0.82%. The free cash flow this company is generating is definitely not enough to sustain growing dividends moving forward. But like I mentioned earlier, we have to keep in mind this company is having to prepare to pay out massive lawsuits. This is going to put a huge hole in the company's balance sheet. So this company simply cannot afford to continue to increase the amount they pay out in dividends at a high rate moving forward. And in fact, I think a dividend cut could potentially happen sometime in the next 3 to 5 years with this company. Now let's go ahead and move forward and look at our valuation. We can see beta of around 1.04, so the volatility is pretty close to that of the market. The first one we'll look at is again going to be Graham's valuation. And again, after plugging in these variables, we come to an intrinsic value of $80.65. Now the next valuation we'll look at is our discounted cash flow analysis. Now this one's a little bit interesting and I'll explain why in just a second, but again we can see I'm assuming a low free cash flow growth rate of just around 1% in line where they've been around the past 5 to 10 years. So assuming that 1% free cash flow growth rate After applying our cash and cash equivalents and our total debt, dividing by shares outstanding, we come to a DCF price per share of $126.37. Now, first off, take a look at the total debt, currently sitting at about $16.8 billion as of 2023, and again, that was automatically pulled in with the ticker data function. But here's the problem. This does not account for the potential lawsuit payouts they're going to have to make. So let's go ahead and bump this up around $10 billion. Let's say total debt comes in at about $26 billion. If we change this number to around $26 billion to also account for the lawsuit payouts, the DCF price per share jumps down to around $109.85, which, while it's not a perfect representation as we don't know exactly what the lawsuit payouts will look like, it does give us a more accurate representation than simply not accounting for it. Now, I didn't use the multiples valuation again in this scenario because I didn't like the comparables. So looking at our dividend discount model again, we're assuming a very low dividend growth rate of just 1%. And with a discount rate of 8%, we come to a dividend discount model price per share of $87.15. Now again, even a dividend growth rate of 1% might not be sustainable for this company moving forward, which should give you red flags as a potential investor in this company. But when we jump over to the output tab, we can see the three valuations that we used. Averaged together gives us an intrinsic value of $92.55, very close to the current trading price for this company. So with a 10% margin of safety, we'd come to an acceptable buy price of around $83.30. Now, as for me, yes, the yield is attractive for this company and the dividend history is attractive, but there's way too many potential red flags with this company right now. The lawsuits are definitely a danger, and I definitely don't want to buy a company that can't sustain growing dividend payments and might not be able to sustain their dividend payments at all. So this is definitely not a company on my radar. The fourth dividend stock on our list is a popular one, and that is SBUX Corporation, stock ticker SBUX, trading at $87.62 per share, and over the past year down 15.4%, and year to date down around 7.61%. Now this one is truly right at its 52-week low. It's 52-week low of $87.61, and again, it's basically 1 cent off from that 52-week low. Now, I covered this stock pretty in depth just a few days ago in this YouTube video here, so again, you can go check out that video if you want a more in-depth analysis on SBUX. But let's go ahead and jump over to our screener, come up here and plug in SBUX and hit enter. Now, the first thing that I noticed is the company has done a good job of growing their revenue per share over the past decade. Earnings per share, for the most part, has done a really good job of growing. You can see there was a pretty large decline in 2020, but that was the case for a lot of businesses. If we look at the profitability and net income spreadsheet, again, we can see growing revenues and a 10-year revenue CAGR of 9.22%. So again, overall, revenues are growing at a pretty healthy rate for this company. If we look at the dividend breakdown for this company, we can see a nice starting dividend yield sitting at about 2.6%. And again, if we look at this yearly dividend payout chart, we can see a nice history of increasing dividends. And again, at first glance right here, it looks like they decreased their dividends, but again, that is because of a stock split. If we jump back over to Seeking Alpha, look at the dividend history and zoom out, we can see it looks like right here in 2015 they had a 2-for-1 stock split. So in reality, they have increased dividends every single year over the past 10 years. And if we look at the 5-year dividend CAGR, sitting pretty solid at around 8.8%, and in reality, the 10-year dividend CAGR would actually be in the double digits if we accounted for the stock split on this sheet. Now we can see the 10-year free cash flow CAGR sitting pretty solid at about 7.66%, but the 5-year free cash flow CAGR is actually showing negative. That's because if we come down here, we can see in 2018, this company produced a tremendous amount of free cash flow, but it's been a little bit lower over the past few years. Now again, we can see with SBUX in 2020, the company produced very little free cash flow and their free cash flow did not cover their dividend payments. But as of right now, they have a free cash flow payout ratio of around 66.17%, which is a somewhat healthy range for the most part. If we jump over to our valuation, we can see a beta of close to 1, so the volatility will be pretty close to that of the market. First valuation, again, we'll run through is going to be Graham's valuation, and we can see after plugging in these variables, we come to an intrinsic value of $87.32. Looking at our discounted cash flow analysis, I'll go ahead and zoom in, and assuming a free cash flow growth rate of around 12%, we come to a DCF price per share of $93.11. Now finally, let's go ahead and use our multiples valuation. You can see the comparable companies we're looking at. And basically what we're doing is we're looking at how the market is valuing these comparable companies by looking at their price to earnings multiple. Now the average PE ratio for these comparable companies is sitting at 26.6. So apply SBUX's earnings per share to that average PE, and we come to an intrinsic value of $95.81. Lastly, if we look at our dividend discount model, assuming a dividend growth rate of around 6%, which is in line pretty close with the 5-year average for this company, maybe just a little bit lower, but also assuming an 8% discount rate, we come to a dividend discount model price per share of $120.84. So jumping over to our output tab, averaging all 4 of these together, we come to an intrinsic value of $99.27. So with a 10% margin of safety, you could see an acceptable buy price of around $89.34, meaning it is in our buy range with that margin of safety. 20% margin of safety, we come to an acceptable buy price of around $79.41. Personally, SBUX is a stock I own in my personal portfolio and I've seen very nice gains from, and I think it's worth considering adding more at its current prices. And the last dividend stock trading at its 52-week low that we're going to look at is Walgreens Boots Alliance, stock ticker WBA, trading at $18.98 per share. And over the past year, it has taken a massive dive, down over 47%, and year to date down around 27.31%. And again, they are truly right at their 52-week low, which is $18.49 per share. Now we have to take note, this company recently had a pretty large dividend cut, and I'll show that here in just a moment. But first off, let's go ahead and jump over to our stock screener. I've already plugged in WBA, and you can see it looks like from around 2013 to 2020, the revenue per share of this business did a pretty solid job of growing, but since then it has been pretty stagnant. Earnings per share in 2023 was negative, obviously not a good sign, and free cash flow per share has been declining by a large amount since 2018. And again, that's a large reason this company had to cut their dividend payments. Dividend payments are paid out of free cash flow, so if a company's free cash flow is declining, really those dividend payments probably aren't sustainable. Now, if we jump over to the profitability and the income statement spreadsheet, here's what we need to really look at. Again, yes, we already touched on earnings per share 2023 negative. Obviously, that's a pretty huge red flag, but here's what I really don't like as well. Look at the gross profit ratio for this business. It's been declining over the past decade, going from around 29.24% to in 2023, 19.46%. That's a pretty ugly chart. That means less and less of their revenue is making their way to the bottom line. We can see the 10-year average gross profit ratio sitting at 23.7, and in 2023, again, 19.46. All those things are not things that I like about this business. Now, if we jump over to the dividend breakdown for this company, we can see they still have a pretty nice starting yield despite the dividend cut, sitting at 5.27. And if we look at these yearly dividend payments, we can see it went from $1.18 to $1.92 in 2023. But with the recent news of the dividend cut, their yearly dividend payment is now sitting at $1 per share, meaning that the yearly dividend is now even lower than it was in 2013. So that was a pretty massive dividend cut. So obviously, because of the dividend cut, we can see negative 10 and 5-year dividend CAGRs, but free cash flow has been pretty ugly as well. We can see for a while, like 2016, 2017, 2018, free cash flow was easily covering the dividend payments for this company, but the free cash flow started to decline while the dividend payments continued to increase, and eventually we can see in 2023, free cash flow was nowhere near being able to cover the dividend payments for Walgreens, leading to a pretty massive dividend cut. Let's go ahead and jump over to our valuation, and again, the first thing I'll point out, beta sitting at 0.72, so you should see low levels of volatility with this company. If we jump over to Graham's valuation, you're going to notice something pretty interesting. If we come over here, we can see we're projecting essentially no earnings growth for this company. But assuming the estimated earnings per share average given to us by Seeking Alpha of about 3.24, we would still come to an intrinsic value of $20.30. That just shows you how bearish the market is on this company currently. Now, if we look at the discounted cash flow analysis, again, this is going to get pretty ugly. Even assuming a growth rate of just 1%, we still come to a DCF price per share of around $2 per share. And look, this is because of the massive debt this company is carrying, low levels of cash and cash equivalents, and even if we add the sum of all the future free cash flows for this company, it's just not more than the total debt for this company. Not a good sign. Typically, again, we look at multiples valuation next, but the only true comparable for this company would be CVS, so it's not a good valuation in this scenario. So the last one we'll look at is our dividend discount model. And again, this values a company based on how much they pay out in dividends and how much that dividend is increasing. Now, the payout ratios for this company should be quite a bit healthier after the massive dividend cut that they've seen. Now, we don't necessarily know what management's approach to the dividend and dividend increases will be moving forward, but it is likely that they'll have the ability, if they choose to increase their dividends at a slow rate, maybe of around 2%. So assuming that dividend growth rate and a discount rate of 8%, we come to a dividend discount model price per share of around $17. So if we jump over to our output tab, Average these three together, you can see we come to an intrinsic value of around $13 per share, which is still quite a bit below the current trading price. So yes, I think maybe the worst of this stock might be behind them with the dividend cut, but there's still just not a lot I like about this company personally. Until I could see something like more predictable and more stable free cash flow per share growth, I really don't think I could ever buy into this company. So there you go, those are 5 dividend stocks currently trading right at 52-week lows. Now, like always, you can download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet at the link in the description and at tickerdata.com. So with all that being said, go ahead and let me know what you think of these companies in the comments down below, and please don't forget to like and subscribe to the channel.